10th India Business Leader Awards, the jury awarded SEBI Chairman UK Sinha for his outstanding contribution to Indian business. It was an opportune time to ask the market regulator about what's in store for 2015.
I will desist from making any comment about what will happen in 2015.
Not from a price point of view at all.
But so far as the robustness of the market is concerned, in the early part of 2014-15, we saw only foreign money coming in, and domestic money was not coming. I'm happy that in the last 6 months, domestic money, especially through mutual funds, has come up in a very positive way, and that I regard as a very healthy development.
Right.
For the robustness of the market, or for providing some sort of a counterbalance to various things which can happen. Only regret which I have is that even today pension money is not coming into the market.
Okay.
And that is something which
Indian pension money.
Indian pension money.
Ah, okay.
Yeah, you're right. Foreign pension money is coming in droves.
Yeah.
In fact, after we changed the FII regulation to FPI regulation in April 2014,
right.
There has been lot of enthusiasm on buy-side people, from people who have been long-term investors, and long-term investors have started coming and getting registered in a big way. So foreign pension, that is my regret, that foreign pension money is coming into the market, taking advantage of the growth of our market and our economy. But by law, by regulation, we are preventing the Indian worker to get advantage of that. If he makes a conscious choice not to come to the market, I have no issues. But how can we prevent him by law not to come to the market?
Okay, fair enough. Sir, when you spoke of foreign pension money and the FPI regime, which has been a big change for India, I know it's really difficult to try and figure out whether foreign investors are coming because of the underlying fundamentals or the move up in equities or a better regulatory regime. How would you assess SEBI's own work on the FPI regime and whether it has helped in simplifying regulations and therefore attracting more foreign portfolio investors to India?
You see, we, government and SEBI, have been holding a number of road shows outside India.
Right.
We have gone to several destinations, and we are getting lot of positive feedback from people. We are getting lot of positive feedback from the investors. That's one way. Secondly, the visitors who are coming to India and they are meeting people in the government or to SEBI, they have no complaints about the regime. In fact, they are all saying that things have become very easy. And the number of registrations have gone up substantially. So people have no complaint on the FPI regime. In fact, they are recognizing that it is a very helpful thing. On FPI, we have no problems, except the demands which are being raised now is that the ceiling on the debt side,
yes,
the macro ceiling on the debt side needs to be increased. But that's a call which government and RBI have to take.
Okay. You recently, in a sense, equalized the regulatory scrutiny that applies to FPI with ODI, or let me put it the other way, that applies to ODI with FPI. Is this your effort to create a level playing field and therefore blunt to some extent the P-note kind of instrument, that has created concerns at various points in time, because there was a fear that sometimes this is anonymous hot money making its way into India, despite all the identification procedures you all have put in place?
Things have changed substantially so far as knowing the end use or end user of the particular ODI. In 2012, beginning of 2012, we came out with the requirements that every FII which has issued a participatory note has to give us at the end of the month the list of people who are the beneficiary owners.
Sure.
If there are any subsequent changes, those changes also they have to disclose. So the nth investor or the holder of the participatory note, SEBI has got details of them. So let me clarify that the worry which was there in 2001 when the market misconduct had happened, those worries are no longer in existence so far as participatory note is concerned.
Sure.
I am not advocating participatory notes. I am only saying that the situation has vastly changed so far as the regulatory regime is concerned. Secondly, I'll like to take you to the committee which I headed when I was not working in SEBI, and there we had recommended this new regime, an FPI regime,
yes,
which has now been implemented. There the whole idea was that if somebody is coming through a participatory note route because of the procedural difficulties in getting registered with SEBI, that has to be removed. So, but there can be still a situation where somebody, for example, is taking a bet on multi-country securities. He has an emerging market fund which is investing in India and also 10 other countries. He will perhaps still find it easy for him to come through a participatory note. So participatory notes by design, one should not understand that they are some hot money or bad money. So long as SEBI is in a position to find out who is the actual investor, who is the actual holder, then there is no problem. Secondly, just to give you one more nuance of it, we have put a stop on participatory notes. You might have seen that about 2.5 months ago, we put a restriction that participatory notes cannot be issued to what is called the protected cell companies. It cannot be issued to opaque structures.
Yes, I saw
so, if through an opaque structure somebody is trying to come who is otherwise not eligible to be an FPI investor, those have also been plugged in.
I know, which is why I'm asking you, sir, are you attempting to blunt the P-note instrument? Because the new requirements that you've imposed on the ODI.
The answer is yes.
Yes, you are attempting to blunt it.
The answer is yes, and I began by saying that this is what was the intention behind the committee which I chaired in 2010.
Okay, so sorry. Yes. So I'm just trying to sort of make it very clear in my head that SEBI is now saying there will be a level playing field, and that we don't want we don't want any regulatory advantages that apply to P-notes, for P-notes to be more attractive.
The right way to understand it is that a P-note holder, the regulatory advantage which a P-note holder was having by having lesser scrutiny,
yes,
that has gone away.
That has gone away.
So I'm not encouraging P-note. In fact, I want them to come through the direct registration.
Exactly my point, sir. Are you disappointed that we haven't seen more primary market activity, even though the secondary market has done such big gains through the course of 2014, record-making gains?
Yes. SEBI was expecting that the primary market will revive. There will be more demand for raising capital. I think I have quoted this number in the past also. A 4-year period ending 2013, 84,000 crores worth of draft red herring prospectus was filed in SEBI, and people either withdrew it midway or they allowed it to lapse. So we were hoping that now companies or corporates will start raising fresh capital. I am not seeing that happening so far.
Why do you think that is the case, sir?
So they have no issues with SEBI procedures. I think the corporates are waiting for some of the stalled projects to start. They are waiting for some visible decisions from the government which will incentivize them to put their money into the projects. They are still a little hesitant in putting money. Maybe, for example, if the coal auction which is going to happen next month and in March, if that coal auction goes through very well, without any problem either with the vigilance authorities or with the courts, if some of the measures which have been announced through the ordinance in the land acquisition bill, if those are taken to their logical, and by that I means they are passed by the parliament, then corporate India will start making investment. Investments are not taking place, and because investments are not taking place, primary market is not getting.
But exits are taking place, sir. Private equity wants to exit. Certain investors that have run through the course of 6-7 year holding periods want to exit. Ideally, the IPO market should be driven by that as well. Ideally, a robust and a rising secondary market always creates, a pipeline in the IPO market. This time, that's not happening.
You are talking of half a reason. It's not a full reason. If you are a promoter and the private equity investor in your company is pressing you, you will perhaps be able to stall it for some more time.
You're saying that it's a matter of time?
It's a matter of time.
In the last 1 month, SEBI has barred over 200 entities from the securities market for indulging in nullified stock transactions to benefit from the long-term capital gains tax exemption. The modus operandi? Well, companies would allot shares on a preferential basis to certain connected entities. The allotments would be at higher than current market prices and the connected entities would soon sell the shares back to the company or related entities at a profit. It's a practice that CNBC TV18's research team has been reporting on for the last 1 year.
Market cap has surged nearly 22,500 crores because there was huge expansion of equity base.
Let me take you back to the developments in the last 3 years. You might recollect that we had a lot of prevalence of a practice whereby there were certain operators who were asking companies to get listed. And there used to be certain amount of manipulation on the opening day.
Right.
We took action, and now we have come out with our very stringent guidelines in 2012, whereby now that is not possible. We have provided for a call option in the pre-open market, and that sets the benchmark. So one set of practice we were able to solve through this mechanism. Then there was this practice of companies trying to issue some shares, rights issues or preference issues, and trying to manipulate the price. This has been happening for some time, and when the market is going up, when the sentiments are optimistic, people with these mentalities try to become much more active. So we looked at it, we found the data was supporting our suspicion. But the investigation takes time because we have to establish the link, and what these people do is to provide several layers. There are layers after layers. So the real person who is behind it was not very easy to come by. We had to go into their bank accounts and other details. So this is a practice which was in vogue. We were able to crack it, and all I can say is that any number of companies who may be indulging in this practice, we will be able to tackle them.
How much more prevalent is this? Because you've cracked down in 2 or 3 cases on a large number of entities. But shall we expect that this exists in many, many more companies?
Many, many more companies, the answer is yes. We have developed some internal models about how the prices have moved and how they are correlated to the fundamentals of the company or not. Based on that, we have come to a number of companies which we are probing, and definitely it is much more than what has already been done.
So we will see many more actions in the future against similar such efforts to rig the market.
We want to control this menace. We want to remove it.